Stop buying silver. I'm serious. Put your wallet away. Close that browser tab. Cancel that order. Because if you buy silver the way most people are buying it right now, you're walking directly into a trap that's been set up for decades. A trap designed by the same financial institutions that crashed the economy in 2008, the same banks that got bailouts while you lost your retirement, the same people who've been playing this game for 500 years while keeping you financially illiterate on purpose. And they didn't teach you this in school for a reason. They kept you dumb intentionally. Because what I'm about to explain is how they steal wealth from people who think they're protecting themselves. The 67 trap. That's the magic number. The price point where retail silver buyers get systematically destroyed while institutional players extract maximum profit. It's happened 3 times in modern history. Same setup, same execution, same devastation for regular people. This isn't conspiracy theory. This is documented market mechanics. CFTC filings, bank trading records, concentration data, you can verify yourself. The numbers don't lie even when the institutions do. By the end of this video, you'll understand exactly how this trap works, why $67 is the kill zone, and most importantly, how to buy silver correctly so you don't become another victim. Because silver itself isn't the problem. Silver is real money, has been for 5,000 years. The problem is how you buy it, when you buy it, and from whom you buy it. The people who understand this will preserve their wealth through what's coming. The people who don't will watch their savings evaporate while wondering how they missed the signs that were right in front of them. Stick with me. The next 20 minutes could save you everything. Let me be clear about something first. I'm not telling you silver is a bad investment. Silver is one of the most important assets you can own right now. It's real. It's tangible. It can't be printed into oblivion like the dollar. Central banks can't create it from thin air. The fundamentals are screaming by. Industrial demand at all-time highs. Solar panels, EVs, electronics, 5G infrastructure, all requiring physical silver. No substitutes exist. Investment demand surging. People losing faith in fiat currencies worldwide. Gold too expensive for average buyers. Silver is the accessible alternative. Supply and structural deficit, 4th consecutive year. Mines depleting. New discoveries taking 15 to 20 years to develop. The setup is perfect. Almost too perfect. And that's exactly the problem. When something looks this obvious, when every YouTube channel, every newsletter, every precious metals dealer is screaming the same thing, you need to ask yourself one critical question. If this trade is so obvious, why would the people who control the markets let you win? The answer is they won't. They never have. And they have a very specific playbook for extracting maximum wealth from retail investors who think they've figured out the game. It's called the $60 trap. And once you understand it, you'll never look at the silver market the same way again. Here's how wealth really transfers in manipulated markets. Not from poor to rich through some vague conspiracy. Through a precise, documented 4-stage mechanical process that's been refined over centuries. I call it the accumulation distribution trap. Stage 1, the narrative build. Financial media starts promoting an asset. Newsletters pick it up. YouTube channels multiply. Dealers increase advertising. The story spreads. Silver is going to the moon. The dollar is dying. You need to protect yourself. Buy now before it's too late. The narrative is usually based on real fundamentals. That's what makes it convincing. Supply deficits are real. Industrial demand is real. Monetary debasement is real. But here's what's happening behind the scenes while you're reading bullish articles. Major institutions are accumulating massive positions at low prices. Dealers reported backlogs. Premiums over spot hit 15%, 20% higher. YouTube channels multiplied. Silver squeeze content went viral. The public mobilized. Stage 3, the trap, April 2011. Silver touched $49.80, nearly matched the 1980 high. The euphoria was identical. This time was different, people said. The fundamentals are stronger. The movement is bigger. We'll break through $50 and never look back. Then, CME Group raised margin requirements. 5 times in 8 days. 5 times. In 8 days. Not because of market conditions, because retail was winning. Silver dropped from $49 to $33 in 2 weeks. A 32% crash. Then it kept falling. $28. 22s. $18, $14. By 2015, silver hit $13.71. A 72% decline from the peak. Everyone who bought above $30 was underwater for years. Many sold at the bottom, financially destroyed, emotionally traumatized. The banks who were short made billions. Again, stage 4, the reset. Silver bears emerged. Silver is manipulated, they said. It'll never break $50. Don't waste your money. A decade of sideways action conditioned another generation to avoid silver. But institutional accumulation never stopped. Quietly, systematically, at prices retail investors had been shaken out of. Then 2020 happened. February 2021, the most blatant example yet. Stage 1, the narrative build, COVID hit. Government printed $10 trillion. Inflation inevitable. Real assets, only protection. The silver squeeze movement emerged on Reddit. Wall Street bets had just squeezed GameStop. Retail investors realized they had collective power. Silver was the next target. Buy physical, drain the vaults, break the manipulation. The narrative spread faster than ever. Social media amplified everything. Millions of new buyers entered simultaneously. Stage 2, the momentum phase. Silver jumped from $25 to $30 in days. Physical dealers sold out completely. Websites crashed from traffic. Premiums hit 30%, 40%, even 100% over spot for popular products. Real physical shortage, real demand, real movement. $30 became the floor, people said. $50 incoming, $100 possible. Stage 3, the trap. But $30 didn't become the floor. The same exact pattern repeated. Futures selling intensified. Paper silver dumped on the market. Unlimited naked short selling that had no physical backing. Price rejected $30, dropped back to $26, then $24, then $20. The premiums that people paid didn't disappear. They just became unrealized losses. By a $26 spot plus $12 premium equals $38 cost basis. Sell at $20 spot minus $2 buyback spread equals $20 return. Effective 47% loss. Stage 4, the reset. The silver squeeze narrative died. Participants were mocked. Nothing changed, the mainstream said. Manipulation is too powerful. But something did change. COMEX registered inventory dropped 50% over the next 2 years. Physical silver actually left the vaults. The movement worked on fundamentals. It just didn't work on price, because price is controlled separately from physical supply until it isn't. So why 67 diamonds? 3 reasons, all documented, all mathematical. First, the inflation-adjusted 1980 high, 49.45 in January 1980, dollars equals $185 in 2025 dollars when adjusted for official CPI. But official CPI is manipulated, uses substitution, hedonics, geometric weighting to understate real inflation. Using the 1980 CPI calculation methodology that was changed specifically to hide inflation, the real equivalent is approximately $600 per ounce. $67 is about 11% of the true inflation-adjusted high. It represents the psychological break-even point where 1980 and 2011 trauma gets healed, where retail investors feel vindicated. That's exactly when institutions want to spring the trap. Second, the options market structure, major silver options. Contracts cluster at $50, $60, and $70 strike prices. Market makers who sold these calls are short volatility. They lose money if price exceeds these levels. Who are the market makers? The same banks with concentrated short positions. $67 is the dead zone between $60 and $70 strikes. Maximum pain for institutions who wrote calls, maximum incentive to prevent that price from holding. Third, the mining cost curve. At $67 silver, virtually every silver deposit on Earth becomes economically viable. Marginal projects that don't work at $30 become profitable. Supply would eventually respond, but supply response takes years. The price spike creates immediate short-term opportunity for institutions to extract retail capital before supply normalizes prices. $67 is the ceiling they'll defend. The line in the sand. The trap trigger. Now I know what you're thinking. If the game is rigged, why play at all? Why not just avoid silver entirely? Because the manipulation can't last forever. And when it breaks violently. Physical silver is being drained from exchanges. COMEX registered inventory down 70% from 2021 highs. London Vault's declining monthly. Industrial users competing for real metal. The paper manipulation works until physical delivery fails. Then price discovery becomes violent and real. The institutions know this. That's why they're accumulating physical while suppressing price. They want to own as much as possible before the reset. But I thought big banks are short silver. The paper positions are short. The physical positions are long. JP Morgan paid $920 million in fines for precious metals manipulation in 2020. What they admitted to was spoofing, placing fake orders to move price. What they accumulated while prices were suppressed. Estimated at over 600 million ounces of physical silver, the largest private hoard in history. They suppressed price to accumulate. Now they own more than anyone. When the manipulation ends, who benefits? But they'll just manipulate it forever. No manipulation survives a physical shortage. You can print paper contracts infinitely. You can't print silver atoms. When an industrial user needs silver for solar panels and there's none available at any price, the paper market becomes irrelevant. Physical price discovery takes over. We're approaching that point. Not there yet, but approaching. So here's how to buy silver correctly. How to avoid the trap while positioning for the inevitable reset. First, never buy at euphoria. When your Uber driver mentions silver, when mainstream media covers the rally, when premiums exceed 30%, that's the trap loading. Wait, be patient. Accumulate during boredom, during despair, during periods when nobody cares. The best buying opportunities feel terrible. They're supposed to. Second, dollar cost average ruthlessly. Don't try to time the bottom. You won't. Nobody does consistently. Buy fixed amounts on fixed schedules, regardless of price. Weekly, monthly, whatever you can sustain. This eliminates emotional decision-making. It ensures you accumulate more when prices are low, less when prices are high. Third, minimize premiums obsessively. The difference between a 5% premium and a 25% premium is your first 20% of gains. Gone. Donated to dealers. Buy larger bars over small coins. 100-ounce bars carry lower premiums than 1-ounce rounds. Sacrifice divisibility for efficiency if your goal is wealth preservation. Generic rounds over government coins. Eagles carry 40% premiums for a stamp. The metal is identical. Fourth, buy from wholesalers when possible. Retail dealers mark up 15% to 30%. Wholesalers work on 2% to 5% margins. The same metal, vastly different prices. Minimum orders are higher. $5,000, $10,000 minimums are common. Save until you meet thresholds. The savings compound dramatically over time. Fifth, store strategically. If you don't hold it, you don't own it. But that doesn't mean keep everything in your bedroom. Diversify storage, some at home for immediate access, some in private vaults in stable jurisdictions. Geographic diversification protects against localized seizure or disaster. Sixth, understand the exit strategy before entering. How will you sell? To whom? At what price points? In what form? Large bars are harder to liquidate than divisible smaller pieces. Pure silver is easier than numismatic coins. Local dealers versus online buyers versus private sales all have different spreads. Plan the exit before the entry. Amateur investors figure this out during panic. Professional investors know before they buy. Seventh, position sizing is survival. Silver should be insurance, not speculation. 5% to 15% of investable assets for most people. Enough to matter, not enough to destroy you if the manipulation continues longer than expected. Overallocation at wrong timing is how retail investors become casualties. The institutions can stay irrational longer than you can stay solvent. Here's what nobody else will tell you. Silver will probably hit $67 eventually. The fundamentals guarantee it. The deficit is real. The industrial demand is real. The monetary debasement is real. But the path to $67 will be designed to extract maximum retail capital along the way. It won't go straight there. It will spike to $35 and crash to $24, rally to $42 and collapse to $28. Build euphoria at $55 and trigger margin calls back to $38. Every spike will feel like the breakout. Every crash will feel like the end. The institutions aren't trying to prevent $67 forever. They're trying to ensure that when it happens, retail investors aren't positioned to benefit. They want you to buy at $35 with 30% premiums and panic sell at $26 for a 40% loss. They want you to leverage at $45 and get margin called at $32. They want you to give up entirely at $22 right before the real move to $100 begins. That's the $67 trap. Not that silver won't reach $67, that you won't be holding when it does. The information is here, the pattern is documented, the mechanics are exposed. Silver is real money. Has been for 5,000 years. The fundamentals have never been stronger. Industrial demand at records, investment demand surging, supply and deficit. But the markets are not free. The same families, the same institutions, the same banks that have been transferring wealth from working people to elites for centuries are running the same playbook they always have. They didn't teach you this in school because they didn't want you to know. Keep them dumb. That's the strategy. That's always been the strategy. Now you know. Buy silver correctly. Accumulate during despair, not euphoria. Minimize premiums ruthlessly. Dollar cost average without emotion. Size positions for survival, not speculation. Don't be the exit liquidity for institutional positions. Don't buy the spike. Don't sell the crash. Don't give up right before the breakout. The 60-cent Oven trap works because retail investors are predictable. They buy when excited, sell when scared, quit when exhausted. Be different. Be patient. Be positioned. Drop a comment below. Tell me your strategy, what you're seeing, what mistakes you've made, what you've learned. I read every comment. Subscribe now and hit the bell because the next video reveals which silver products have the lowest real premiums, which dealers actually offer wholesale pricing, and which storage options provide genuine security without ridiculous fees. The information the industry doesn't want you to have. Because here's the truth about this channel. I don't sell silver. I don't get commissions from dealers. I don't benefit when you overpay for premium products. My only incentive is giving you information that actually helps. The same information the wealthy have always had. The same information they kept from you intentionally. The playing field isn't level. It never has been. But knowing the game exists is the first step to not losing it. Silver will hit $67, then $100, then higher. The fundamentals guarantee it. The only question is whether you'll be positioned correctly when it happens. Whether you'll have the knowledge to avoid the traps, the patience to accumulate properly, and the conviction to hold through manufactured volatility. That's what separates the people who build generational wealth from the people who become generational warnings. The choice is yours. And remember, in a rigged game, the winners aren't the smartest or the richest. They're the ones who understand the rules that aren't written down. The ones who see the trap before it springs. The ones who refuse to be predictable. Don't be their exit liquidity. Be the one still holding when the music stops.